All right, welcome back. Let's talk about the standard deduction. So the standard deduction is what? It's deduction that's allowed for individuals. It's the basic standard deduction. For single filers, it's $12,400, right? And it's based on the taxpayer's filing status. So we have a standard deduction amount. There's additional deductions that can be added to the standard. So if you're a taxpayer, you're allowed two types of deductions. And again, the deductions that we're focusing on are from AGI. So once we have the adjusted gross income, we're going to deduct various expenses that we've incurred. The expenses themselves, if we have several of them, will be itemized, and we'll talk about itemized deductions later. If we don't have enough expenses to meet that itemized deductions above the basic standard deduction, we can choose the standard deduction. And the standard deduction they have set rates. However, there's certain situations where we can add to that standard deduction amount. And that's going to be based on a few factors. The first is age. So if we're age 65 or over in 2020, or if a claimant is blind or becomes blind in 2020, there's additional deductions that are allowed for those individuals. It depends on the filing status. So let's look at the basic standard deduction. The basic standard deduction for single filers is $12,400, and we're going to be on 2020. But you can see how there was a slight increase in 2019. So in 2020, the standard deduction is $12,400. For married filing jointly, it's double, $24,800. We have different filing statuses. So there's a head of household. Head of household is somebody who, like it says, is the head of a household, is not filing married or filing jointly, and has dependents. And there's qualifications to meet a head of household status. If you are a head of household, you're allowed a higher standard deduction of $18,650. And then if you're married, filing separately. So you can, if you choose, file separately from your spouse. If you choose to go that route. Typically you don't see that often, but you might see that if one spouse has several businesses or business income. And there's a benefit of separating that business for that spouse on that tax return versus the other spouse. But typically, if you're married, you're going to file jointly. But here's the basic standard deductions amounts. And here's the additional amounts. Here's the additional amounts for taxpayers age 65 or older and or legally blind. So if you're age 65 or older, or if you're legally blind, you get to add $1,650 if you're single, $1,300 for married filing jointly, $1,650 for head of household, and $1,300 for married filing separately. This is a question on 3.21. There's a question where we have a couple that's over the age of 65. So you'll need to refer back to this table to figure out what the standard deduction would be for that couple. Since they're over the age of 65, they get to add to the standard deduction. And the standard deduction for married is $24,800. So look for that question in 3.21. Individuals not eligible for the standard deduction, and this also comes up in 3.21. So some individuals are not allowed to use the standard deduction. The one that we'll see, I believe this is on the homework, married filing separately, where either spouse itemizes their deduction. So we said before, if the status is married filing separately, you're allowed each spouse on their individual return, since they're filing married filing separately, they're allowed a standard deduction of $12,400 apiece. However, if one of the spouses decides to itemize their deduction, so they get a deduction greater than $12,400, then the other spouse is not allowed to use the standard deduction. So that's one limitation of married filing separately. That is definitely a question on 3.21. So look for that. Other special limitations. So individuals that are claimed as dependents, and they as dependent has a basic standard deduction in 2020. There's a limit. So if you're claimed as a dependent, so let's say you're under the age of 18, or let's say you're under the age of 20, you're working, you have an income, but you're being claimed as a dependent from your parents. So your parents are claiming you as a dependent because you live at the house and you meet all of the tests to become a dependent. The standard deduction is limited to $1,100 or $350 plus earned income. What does that mean? That means if you earn zero income and you're a dependent, if you earn zero earned income, maybe you earned income from investments or from a dividend, but if you have zero earned income and you're a dependent, you're allowed a standard deduction of $1,100. If you earned income, which earned income is generally W-2 wages or 1099 wages. 1099 wages if you're a contractor. If you earned income greater than the 1,100, then the standard deduction would be that earned income plus $350. So you take the earned income, you add $350, but you can't exceed up to the 12,400. So you can't exceed the basic standard deduction. So these are the limitation rules. This is definitely a question on 3.21. So make sure you refer to this. And then we could talk about exemptions and dependents, the relationship test, and then I'm going to probably post one more video. So there's two types of exemptions: personal and dependency. Personal exemptions are granted to the taxpayer and the spouse. Dependency exemptions are allowed for qualifying child or relative. So the exemption amount in 2020 is $4,300. So for each qualifying child or qualifying relative, you're allowed $4,300 in exemptions, and exemptions are going to be a deduction from adjusted gross income. In order to be a dependent, you have to meet certain tests. So there's a relationship test, a residence test, an age, and a support. So there's a relationship test, which is how you related to that dependent. There's a residence test, right? Do they live in your house or not? Where do they live? There's an age test. How old is that dependent? And the support test is how much support do you give that individual to be a qualified dependent. And support means pretty much, how much income are you giving them? Are you giving them food, shelter, housing? All these will fall under the support test, okay? So when we talk about the relationship test, take a look at this slide. We'll go through it quickly, but pretty much the taxpayer must, so the child must be the taxpayers to be a child, son or daughter, adopted child, stepchild, and then we have a host others down here, which could be eligible foster child, stepbrother or stepsister, half brother, half sister. There's all sorts of relationship tests down below that might not meet the standard relationship, which is son or daughter, or adopted child or stepchild, foster child, that you could meet. And then we could go on with the relationship test there, but the first test is the relationship test. The residence test is the qualifying child must live with the taxpayer for more than half the year. So they must live on the residence for more than half the year. Temporary absences, so school, vacation, military, are ignored. So if you're a dependent, you live at home, but you go to school for X amount of months for the year, you're still going to be 100% at the tax the filers, the tax filers home. So you'll qualify in that example as a child if the person was a child. Age test, right? So the child must be by the end of the tax year under 19 or under 24 and a full-time student. So back to the residence test, we talked about a college student. So if you have a child and they meet the relationship test, it's a child, and the child lives at home, they meet the residence test. And if they go to school, away from the home, we ignore it because it's a temporary absence. And they would also meet the age test because they're 20 years old and a full-time student. So that's the age test. And you need to meet these tests in order to be a qualifying dependent, to be a qualifying child. And then to be a qualifying child, the individual must not be self-supporting, meaning the child can earn income, but they can't earn more income, enough income that they could be self-supporting. And there's certain rules there, and we talk about tiebreaker rules. A dependent can also be a qualifying relative. A qualifying relative must meet the relationship test, the gross income test, and the support test. So the relationship test for the qualifying relative, it's pretty much parents, grandparents, uncles, aunts, and then certain in-laws, right? So you need to be pretty much some sort of in the nuclear family. So parents, grandparents, uncles, aunts, and then certain in-laws to meet the relationship test to be a qualifying relative. The gross income test for the qualifying relative. So the dependent's gross income must be less than the exemption amount. So that's $4,300. So to have a relative, so let's say you have a parent, right, that you're taking care of, and you want to claim that parent as a dependent, they must meet the relationship test, which is that they're a parent, right? So they meet the relationship test. B, they need to meet the gross income test, and the gross income test is that they can't make more than the exemption, which is $4,300. So any earned income has to be less than $4,300. And then finally, there's a support test, and the support test is usually over half. So you are providing more than half of the support for that relative, meaning if we go back to the parent example, the parent is living at home, you're providing food and shelter, you would meet the 50% test. And I think we're going to stop there. There'll be one more video that I'm going to record in a minute, but this is going to finish the video on standard. We talked about standard deductions. We talked about personal exemptions and how you can claim dependents. And we talked about the rules to be able to be claimed as a dependent. So let me stop my share. Whoops. Let me stop my recording is what I meant to say. And I'll be back in 1 minute.